ServiceNow, ticker symbol NOW. I tuned into their earnings. It took me a bit to catch up to all the various companies that were reporting. There was a lot of them. I thought it was stellar. They beat on the expectations and they even raised their guidance. Sorry, my hand wasn't showing up for some reason. They even raised their guidance for the rest of the year. So why the heck in the after hours did they sell off by 13.4%? Well, number one, they had one of their bigger deals get postponed because of the current Middle East conflict. And unfortunately for ServiceNow, Wall Street, they were basically pricing that in to be a given, but they pushed back and said, we couldn't get it done. Number two, they recently acquired two smaller fish in the pond, and because of that, their margins were not as stellar as Wall Street expected it to be. Because when you buy out another company, you're not necessarily going to bring on over every single employee. So there's severance costs, there's legal costs, there's reconstructing costs. But do keep in mind, those are one-time fees, but fees do add up, and it's going to affect the bottom line, how much profits go into the pockets of ServiceNow. And number three, if you take a look at their PE ratio, which is the trading multiple, it's a 61.7. So they're trading for 61 times their earnings per share. But that's not really fair because this is a growth company in question, right? Based on their forward EPS, forward PE ratio is a 22. So it's a lot more palatable, digestible, so it's not too bad. Nonetheless, they're still priced for perfection because there are some investors that look at companies by only the trailing 12 months EPS. So at a 61, you can't just beat the expectations. Let's say they expect you to hit $200 million in your gross sales. You can't just come out and say, hey, we hit $210 million. No, they need you to blow them out of the waters with like $340 million in revenue, even though the expectation was $200 million. Well, that brings me to my next point. The reason why I tuned in and I paid attention to their earnings is because they are on my watch list. I think they are a high quality compounder. Unfortunately, they do not pay a dividend, but I consider them to be a tier 2 in the SaaS landscape. Now, I have their fair value estimate at roughly $150 a share. They're nowhere near that. And yes, that's a revised expectation with the numbers that they laid out today. Because when the stock market opens, by the time you watch this video, it could easily be $85 or even $81 a share. So usually when I see that kind of discrepancy from their current trading price to that of their fair value estimate, and the gap is like 40-50% to the upside, usually that weighs heavily on my decision making to maybe open a position. But in this case, I think the reason why I hesitate, like heart to heart, is if they just had this stellar of an earnings where they beat on everything and they even raise their guidance and they still get punished by 14%, it makes me scared to jump in, especially as an investor, because if this happens again in the next quarterly earnings report, they smash it, and they get punished again by another 14%, you know what I'm saying? I think as crazy as it might sound, the expectations for ServiceNow, a little too high. So for me, I'm going to pass.